Welcome to The Explainer, where we break down the story behind the numbers. Today, we're tackling the Indian stock market. It's been hitting some incredible new highs, right? But what's really going on under the hood?
All right, so in late 2025, India's main stock market index, the Nifty 50, did something pretty spectacular. It surged to a brand new all-time record, blowing past the 26,000 mark. Now, on the surface, that looks like a huge win for investors. A massive celebration, right? Well, that single headline number, as impressive as it is, it's actually hiding a much more complex and frankly more fascinating reality. See, it turns out not everyone was invited to this record-breaking party.
Okay, let's dive into our first point, record highs but limited gains. The first clue to what's going on here is a term the report uses, limited breadth. So what does that actually mean? Well, simply put, it means the gains just aren't being spread out evenly across the board. Take a look at this. When you break down the 50 big companies that make up the Nifty index, only about half of them, 26 to be exact, actually hit a new all-time high this year. That means the other 24 companies, they're still lagging behind. So here's the key takeaway. This is not a case of a rising tide lifts all boats. Not at all. Instead, this new record high is really the result of a concentrated surge. It's being powered by a very small, select group of superstar companies. All right, next up, the sector scorecard. This is where you see the real winners and losers. And believe me, this concentration gets even clearer when we start breaking it down by industry. It reveals a huge performance gap, basically a market of haves and have-nots. And this chart just illustrates that point perfectly. Look at the huge difference here. On one side, you've got public sector banks. They've more than doubled in value, soaring 117%. But then, on the complete opposite end of the spectrum, you have the media sector, which has actually lost 19%. And this just drives the point home even further. You can see a clear split in the economy. On one hand, you have the more traditional industries, public banks, auto, metals. They're just powering ahead. But on the other side, key sectors like media, real estate, and even technology have really been left behind this year. So that brings up a big question. What's fueling this divide? Well, a huge part of the answer is a major shift in ownership. We're talking about who is actually doing the buying and selling in the Indian market. And honestly, this is one of the most important stories happening right now. And here it is. For the first time in history, a huge milestone has been crossed. Domestic institutional investors, that's your Indian mutual funds, your insurance companies, they now own a bigger piece of India's top 500 companies than foreign institutional investors do. The report itself doesn't pull any punches here. It calls this a historic shift. And that's exactly what it is. This isn't just some temporary trend or a little blip on the radar. No, this signals a really deep, structural change in how the Indian market works. It's relying on local money now more than ever. And just look at this number to see what I mean. $81.3 billion. That's the staggering amount domestic investors have poured into the market just this year. And at the exact same time, foreign investors have actually been pulling money out. They've been net sellers. This is the fuel that's behind that historic shift. Okay, so with all this domestic money pouring in and the market hitting record highs, it leads us to a really critical question, one any investor should be asking. Are Indian stocks getting too expensive? Are things getting overheated? To get an answer, we can look at a pretty simple metric called the price-to-earnings ratio, or PE ratio for short. The easiest way to think about it is like a price tag for a stock. It just tells you how much you're paying for every dollar of profit the company makes. So is the market in a bubble? Well, based on this, the Nifty 50's overall price tag is trading just about 4% above its long-term average. So yeah, prices are a little elevated, but it's not in the extreme danger zone. But, as we've already learned today, that big headline number doesn't tell the whole story. And this is where things get really interesting, especially if you're an investor. Look at this. Some of those very sectors that have been lagging behind, like technology and private banks, well, they're actually trading below their historical average price tag. This could be a sign that there are some real potential bargains hiding in plain sight, right inside this record-breaking market. And speaking of the tech sector, this leads us to the report's big forward-looking call. The analysts are making a strategic bet on the IT sector, and they believe a comeback is on the horizon, all thanks to the next big wave in AI. Okay, so the argument here is that we're at a really crucial turning point in the global AI spending cycle. We're moving past that first phase, which was all about the infrastructure build out, buying all the expensive hardware. The next phase, where we are now, involves a massive shift in spending towards the software and services that actually use all that powerful AI.
And this is the key. This exact shift, from hardware to software and services, it aligns perfectly with the strengths of India's big IT companies. They're basically perfectly positioned to capitalize on this wave, and that could mean their recent period of underperformance might be about to end. So let's bring it all together. While the headlines are all screaming record high, the real story here is a market undergoing a profound transformation. You've got domestic investors firmly in the driver's seat and a potential tech revival on the horizon. So the big question isn't just about what happens next, it's whether we're seeing the very beginning of a whole new chapter for the Indian market.